Welcome back to the ProTicker Podcast, everyone. Your Monday morning edition covering major financial magazine headlines.
Yeah, it's a new week, and that means a whole new wave of market-moving news.
But don't worry, we're here to help you navigate it all with the deep dive.
Exactly. Think of this as your Monday morning briefing. We're sifting through the noise to bring you the most important insights from those big financial publications.
MarketWatch, Bloomberg, The Wall Street Journal, you name it.
We read it all so you don't have to.
And today our mission is to break down the key financial headlines for Monday, March 17th, 2025.
Lots to cover. So let's dive right in, shall we?
Yeah, let's kick things off with something that's been on a lot of investors' minds lately, and that's a shift in sentiment.
Right. It feels like the market's mood has definitely shifted. Earlier this year, there was this sense of optimism, but now...
Now it's like everyone's hitting the brakes a little bit.
Yeah, and we're seeing that reflect in some major firms revising their forecasts.
Lowering their expectations for the rest of the year.
Exactly, and one example of that is an article from MarketWatch titled, "The Market's at a Fork in the Road," says RBC, as it becomes third firm to cut S&P 500 forecasts.
Oh yeah, RBC Capital Markets, they just lowered their year-end target for the S&P 500 to 6,200.
Right down from 6,600,
Which actually puts them right in line with similar downward revisions we've seen from Goldman Sachs and Yardeni Research too, so it's not just that.
It's a trend, isn't it? And it makes you wonder what's driving this collective pessimism.
Well, RBC says the path for stocks is looking a bit more rockier these days. They even use that word rockier in the article.
And they're basing this on some pretty in-depth economic models. They've got a whole range of potential outcomes they're considering.
Yeah, the MarketWatch piece goes into that. Their most pessimistic scenario puts the S&P at 5,682 by the end of the year, and that's tied to their outlook on GDP.
But their most optimistic model still sees it reaching 6,520.
Quite a spread there.
Yeah, and it all hinges on a few key factors, which, we should definitely unpack.
Yeah, absolutely. I mean, what are they seeing as the biggest headwinds, so to speak?
Well, one of the main things they point to is this stubborn inflation. It just won't go away. They even call it sticky inflation in the article.
It makes sense. If inflation stays high, it can really limit how high valuations can go.
Right. And then there's this other thing they talk about in the MarketWatch piece. It's this really interesting analogy. They say the market is at a fork in the road.
Like we're at crossroads.
Yeah. And for you, the listener, the takeaway here is that the direction we go from here isn't predetermined. It really depends on a few things.
Things like what happens with government policy, what the actual economic data tells us in the coming months.
And of course, we can't forget about earnings season that's coming up, and that's always a big driver of market sentiment.
Absolutely. So it's not all doom and gloom, but there's definitely this sense of caution in the air.
Yeah, and it's not just the big investment firms feeling it either. Everyday investors are getting a little nervous too.
Definitely the same MarketWatch article actually mentions this. They talk about a weakening in what they call vibes across the board, like that gut feeling is changing.
Yeah. They cite the AAII survey, which tracks retail investor sentiment, and it's turned decidedly bearish lately.
And we're seeing less optimism from institutional investors, too. Those big players who manage huge amounts of money.
Plus, the article highlights that even credit and options markets are flashing some warning signs, what they call elevated angst.
So it really does feel like everyone's a little bit on edge right now.
And you can't blame them. There's a lot to be uncertain about.
For sure. And that uncertainty seems to be impacting consumer confidence, too.
Absolutely. There's another MarketWatch article titled "Stock Market Bulls Abandoned by Trump Won't Be Saved by Jerome Powell and the Fed" that talks about this.
Yeah. And they highlight a pretty significant drop in the University of Michigan Consumer Sentiment Index.
Down to a 29-month low. That's the lowest it's been in a while. And for you, the listener, this matters
because consumer spending is what drives a huge chunk of our economy.
Exactly when people feel less confident, they tend to tighten their belts, they don't spend as much.
And that can have a ripple effect throughout the entire economy.
Absolutely.
Yeah.
But it's not just about how people are feeling right now, it's also about the uncertainty of what's to come.
That fear of the unknown, especially when it comes to government policy.
Yeah, the same MarketWatch article actually mentions this. They talk about the U.S. Economic Policy Uncertainty Index.
And get this. It's reached levels we haven't seen since the start of the COVID-19 pandemic.
That's a pretty stark comparison, and it really underscores how much uncertainty is out there right now.
No kidding. And what's interesting about this whole policy uncertainty thing is,
Read that.
well, there's this quote in the MarketWatch article from Kevin Gordon at Charles Schwab, and he argues that this policy uncertainty might actually be worse than the tariffs themselves.
That's an interesting perspective. Why would he say that?
Well, His reasoning, and it makes a lot of sense, is that businesses can plan for tariffs.
Hmm.
They can adjust their strategies to deal with
They're a known quantity.
Exactly.
Yeah.
But this constant state of flux,
Yeah.
this not knowing what's coming next.
It makes it really hard for businesses to make decisions about investing, expanding hiring, all those things that drive economic growth.
Right? They just don't have the clarity they need.
And this policy uncertainty isn't just affecting the U.S. either. It's having global repercussions.
Oh, yeah, I saw an article about that in MarketWatch as well, titled, "The U.S. Growth Outlook Was Just Cut by the OECD on Uncertainty and Tariffs."
The OECD, that's the Organization for Economic Cooperation and Development, they just lowered their growth forecast for the U.S.
And guess what? They specifically cited policy uncertainty and tariffs as the main reasons.
So this is really becoming a global concern.
It is. And, to understand the potential impact, the OECD is looking at some pretty drastic scenarios.
Oh, yeah, they're not just talking about the existing tariffs between the U.S. and China or even the steel and aluminum tariffs.
They're actually factoring in the possibility of the U.S. slapping a 25% tariff on most goods coming from Canada and all goods from Mexico.
Wow, that would be a huge escalation in the trade war.
It would, and the OECD has crunched the numbers on what that would mean for the U.S. economy.
So what's the verdict?
Well, under that scenario, they project that U.S. GDP growth would slow down to 2.2% in 2025.
And then dip even further to 1.6% in 2026.
So a pretty significant slowdown, but what's even more concerning is the potential impact on Canada and Mexico.
Yeah, the OECD thinks Mexico could actually slip into a recession if those tariffs were implemented.
And this really highlights how interconnected the global economy is. What happens in one country can have ripple effects all over the world.
Absolutely. And the OECD is pretty clear about the potential downsides of these tariffs, even if they do lead to increased government revenue in the short term.
They argue that they'll ultimately drag down global economic activity, reduce incomes for many, and probably lead to higher prices for consumers and businesses.
So it's not a simple win-win situation. There are real costs involved.
For sure. And all of this uncertainty sets the stage for a pretty crucial event happening this week.
What's
The Federal Reserve meeting. It's happening on March 18th and 19th, and there's a lot riding on it.
Yeah, I was just reading a couple of articles from Bloomberg about this Fed meeting this week. Has investors anxiously awaiting Powell's remarks, and traders look to Powell for signs Fed is ready to step in.
It seems like everyone's watching Jerome Powell very closely right now.
He's got a tough job ahead of him.
He does, because he needs to reassure investors that the U.S. economy is still in decent shape.
But at the same time, he can't ignore all these growing concerns about the trade war and the volatility we're seeing in the markets.
So he needs to strike this delicate balance, project confidence, but also signal that the Fed is ready to act if things get worse.
Yeah, it's a tightrope walk, for sure. And for you, the listener, Powell's tone and the Fed's overall message this week will be very important.
Definitely worth paying attention to, because it could give us some clues about where the market might be headed.
Now, most analysts are expecting interest rates to remain unchanged at this particular meeting.
Right. But there's a lot of speculation about what might happen later in the year.
Yeah, the Bloomberg articles I mentioned point out that traders are actually pricing in a pretty high probability of at least 3 rate cuts this year.
3 cuts. Wow. And some are even betting that the first cut could come as early as June.
Which is interesting because economists on average are only expecting maybe 2 cuts this year,
So the market might be getting ahead of itself a bit.
it's possible, and we'll have to see what the Fed's own updated economic projections look like.
Those are coming out after the meeting, right?
That's right, and Bloomberg suggests we might see some slight downward revisions to their growth forecasts.
And maybe even a small upward adjustment to their outlook on core inflation.
Which would make things even trickier for Powell and the Fed if they're seeing inflation potentially ticking up. It makes it harder to justify cutting rates.
Exactly, because as the Bloomberg articles emphasize, Powell's been pretty consistent in saying that the Fed needs to see clear evidence that inflation is sustainably moving back towards their 2% target.
And that expectations for future inflation are staying anchored, not spiraling out of control.
Only then would they feel comfortable actually lowering interest rates.
So it's going to be a data-dependent approach as always.
Absolutely.
Yeah.
Now, there's this quote from Dominic Konstam of Mizuho Securities USA in one of the Bloomberg pieces, and I thought it was pretty insightful.
What did he say?
Well, he basically said that Powell needs to signal to the market that the Fed is watching it, when it comes to this recent slide we've seen in stock prices.
So basically acknowledge that they're not oblivious to what's happening.
Right, because even though the Fed's official mandate isn't to manage the stock market, they can't completely ignore big drops.
Because those drops can have broader implications for the economy. They can affect confidence and financial stability.
Absolutely. And we're already seeing signs that the market is super sensitive to any hints about what the Fed might do,
Oh, yeah. The Bloomberg articles mentioned the recent decline in the two-year Treasury yield.
which is often seen as a barometer for near-term interest rate expectations. What the market thinks the Fed will do with rates.
And that decline suggests that investors are really on edge waiting for any signal from the Fed.
Absolutely. Now, there's another thing that's being discussed in relation to the Fed, and that's the possibility of them pausing or slowing down quantitative tightening.
QTA for short, right?
Right. Essentially, the Fed has been reducing the amount of bonds it holds on its balance sheet.
Which can affect liquidity in the financial system. It can make it harder to borrow money.
Exactly. And the minutes from the Fed's January meeting actually showed that policymakers were already talking about this possibility.
Especially in the context of those potential debt ceiling negotiations that could be coming up.
So that's another thing to keep an eye on because it could have a big impact on markets.
It could. And, this whole situation with the Fed, it's interesting to think about it in terms of the Trump put and the Powell put.
Right. Those are terms that get thrown around a lot to describe the market's expectation that either the previous administration or the current Fed would step in to support falling stock prices.
Like a safety net for the market.
Exactly. But the question is, do those puts still exist?
Well, an article in MarketWatch that we mentioned earlier, Stock Market Bulls Abandoned by Trump Won't Be Saved by Jerome Powell and the Fed, suggests that maybe they don't.
Yeah, they point out that Treasury Secretary Scott Bessent doesn't seem too worried about the recent market downturn.
Right. He actually said that corrections are healthy and that he's optimistic about long-term growth thanks to the administration's policies.
So he's not rushing to intervene.
And there's a quote from Stephen Brown at Capital Economics in the same article where he argues that the current risks of inflation make a Powell put pretty unlikely at this point.
Meaning the Fed is unlikely to step in preemptively to prop up the market.
So investors who might have been counting on that safety net in the past may need to rethink things.
For sure. Now let's switch gears and see what's happening over in China.
Yeah, I was just reading an interesting article from Bloomberg about this. China maps out plan to raise incomes and boost consumption.
They're really trying to boost their domestic economy.
They are, and it makes sense given all the global headwinds they're facing, the potential impact of U.S. policies and the overall economic uncertainty.
Exactly. They're realizing that they need to rely more on domestic demand, especially with their export sector potentially taking a hit.
And Bloomberg reports that boosting consumption has become a top priority for the Chinese leadership.
Like a major strategic shift.
It is, and they've laid out a pretty detailed plan on how they're going to achieve this.
Oh yeah. Their State Council report is full of guidelines and measures aimed at boosting spending.
And one of the key focuses is directly increasing household incomes.
Putting more money in people's pockets so they can go out and spend it.
Exactly, and the Bloomberg article outlines some of the specific measures they're considering.
Things like stabilizing their stock and real estate markets, which would help boost wealth.
And also offering incentives to encourage a higher birth rate.
Because more babies means more spending on, diapers and clothes and all that stuff.
Right, and they're also talking about making big improvements to childcare facilities and policies.
Because affordable childcare can free up more income for families to spend on other things.
Absolutely, and they're really emphasizing the need to enforce paid leave policies more effectively.
Which is important because paid leave can help families manage unexpected expenses without having to dip into their savings.
Right, and then there's the focus on promoting reasonable growth in wages.
So making sure people's incomes are keeping pace with the cost of living.
Exactly, and there's this great quote from Lynn Song of ING Bank in the Bloomberg article. She says, "Households can't spend what they don't have."
Which is so true. You can't boost consumption if people don't have the money to spend.
And all these measures suggest that China is getting serious about tackling this long-standing issue of weak domestic consumption.
Now they've set themselves a pretty ambitious goal. They're aiming for economic growth of around 5% in 2025.
And to achieve that, they're willing to run their biggest fiscal deficit in over 3 decades.
So they're really pulling out all the stops.
They are, but it won't be easy.
No. Bloomberg highlights the recent data showing weak retail sales and even deflation in February.
Yeah, those are not good signs for an economy that's trying to boost consumption.
So they've got their work cut out for them,
But they're taking concrete steps, and the market seems to be responding positively.
yeah. Bloomberg mentioned that Chinese stocks actually rallied after the announcement of these plans.
So there's some cautious optimism that these efforts might actually pay off.
Fingers crossed now, let's shift our attention to the world of technology in cryptocurrency.
Always a lot happening in those sectors.
Absolutely. And there's been some interesting news about Apple lately.
Let's go on with them.
Well, there's an article in MarketWatch titled, Apple now faces a problem far bigger than tariffs or weak iPhone sales.
Oh, that sounds serious. What is it?
Well, it seems like they've run into some trouble with their AI ambitions.
Really?
Well, they've been heavily promoting these advanced Siri features, powered by AI.
Right. I remember seeing the commercials for the iPhone 16. They made a big deal about it.
Exactly. But the problem is those features aren't actually ready for prime time.
What, they're not? They've been advertising them for months.
I know it's a bit of a mess, and the MarketWatch article is pretty scathing in its criticism. They quote John Gruber.
Oh, yeah. He's like the Apple guru.
He is. And he basically says that Apple has squandered its credibility by hyping up these features that weren't even close to being finished.
Ouch. That's got a sting coming from him.
Yeah, and the timeline is pretty telling. They first teased these AI enhancements at their big developer conference back in June.
WWDC, right?
Yeah, then they doubled down on it when they unveiled the iPhone 16 in September.
And now they're having to admit that they overpromised and underdelivered.
Exactly. And it seems like even internally at Apple, they're not happy about this.
Really?
Yeah, there was a report from Bloomberg News that said Apple's own Siri chief called the delays ugly. Ugly? That's pretty strong language for a company like Apple.
It is, and it shows that they know they messed up.
And the market definitely took notice, too.
Oh, yeah. MarketWatch reports that Apple's stock price took a big hit after they confirmed the delays.
And it actually underperformed other major tech companies that were also facing headwinds.
So it seems like investors are worried that Apple is losing its edge when it comes to innovation in the AI space.
Yeah, that's definitely a perception problem they'll need to address.
For sure. Now, on a slightly more positive note, there's another tech company that investors are watching closely.
And who might that be?
NVIDIA. They've had a bit of a roller coaster ride this year.
Yeah, their stock is still down over 9%, but it has rebounded a bit recently.
And investors are hoping that CEO Jensen Huang can keep that momentum going.
He's got a big keynote speech coming up.
He does, and a Bloomberg article titled NVIDIA, Investors Look to CEO Keynote to Keep Rebound Going, talks about all the things investors will be listening for. They're hoping for some updates on their Blackwell products line, which is supposed to be their next big thing.
And they want to hear about their gross profit margins, which have been under pressure lately.
Plus, they'll be looking for insights into their strategy for dealing with the tricky situation in China.
And how they plan to fend off increasing competition from other chip makers.
Of course, everyone wants to know about their growth prospects. Is NVIDIA's recent success sustainable?
Right, because there's definitely some skepticism in the market about that.
And this skepticism seems to be part of a broader trend of selling pressure in big tech stocks.
Bloomberg mentions that investors are getting a bit jittery about all the uncertainty surrounding tariffs and all the money companies are pouring into AI development.
Like they're wondering if it's all a bit too much too fast.
Yeah, exactly. Now let's talk about some interesting developments in the cryptocurrency world.
Always a lot of intrigue there.
There is, and there's been some news about David Sachs, President Trump's newly appointed AI and crypto czar.
Oh, yeah. What about him?
Well, a CNBC article titled, David Sachs sold $200 million in crypto holdings before taking WH job. Reports that he made some big moves with his crypto investments.
Really? What kind of moves?
Well, before he took the job in the White House, he sold off over $200 million worth of digital asset-related investments.
Wow, that's a lot of crypto.
It is, and it included both his personal holdings and those held through his venture capital firm, Craft Ventures.
So he really cleaned house.
He did, and according to the article, he did it to avoid any potential conflicts of interest.
Yeah.
Now that he's in a position to influence policy.
That makes sense, but it's pretty different from what we've seen from other people in the Trump administration.
Right. The CNBC article points out that both President Trump himself and Elon Musk, who is a close advisor, still have big stakes in companies and projects that could be affected by government decisions.
So Sachs is taking a more cautious approach.
He is. Now, the CNBC article also mentions the U.S. Strategic Bitcoin Reserve.
Oh, yeah, that was President Trump's idea, wasn't it?
He signed an executive order to create this reserve, which would be funded by Bitcoin seized by the government.
So the administration seems to be embracing crypto on some level.
They do, but then we have this other development that seems to contradict that.
What's that?
Well, according to a Bloomberg article, U.S. Bitcoin ETFs shed $5.5 billion in longest run of outflows. U.S. Bitcoin ETFs have been experiencing massive outflows of money.
$5.5 billion over the past 5 weeks. That's a lot of selling pressure.
It is, and Bloomberg links it to the broader market's aversion to riskier assets, because of all the uncertainty around President Trump's proposed tariffs.
So basically, even crypto investors are getting spooked by the trade war.
It seems that way, and
Right.
as Bloomberg points out, Bitcoin's price has been pretty flat this year.
Despite the initial jump it got after President Trump's election.
Right, so the crypto market is definitely reacting to these broader macroeconomic factors.
It is now. Let's move on to some news from the labor and banking sectors.
What's happening there?
Well, the Wall Street Journal has an exclusive report titled Bank of America Tightens Oversight of Junior Bankers' Hours.
Oh yeah, this is about the young associate who tragically passed away after working really long hours.
It is, and it seems like Bank of America is taking steps to prevent something like that from happening again.
They're tightening their oversight of junior bankers' workloads.
And they're doing it by shifting the primary responsibility for supervision to permanent senior banker roles.
So instead of relying on mid-level employees who rotate through those positions, they're putting more experienced people in charge.
Which makes sense because those senior bankers have more incentive to protect their junior colleagues.
And they're also eliminating around 150 junior investment banking positions.
So it seems like they're trying to reduce the overall workload.
But the Wall Street Journal article points out that this could backfire.
How so?
Well, if there are fewer junior bankers to do the work, the remaining ones might end up with even heavier workloads.
Yeah, that's a valid concern. And the journal also reminds us of past investigations where bankers were allegedly instructed to underreport their working hours.
So there's a history of this kind of thing in the industry.
Definitely something to keep an eye on.
No, on a broader labor market note, MarketWatch has a really concerning report titled, "They Lost Their Federal Jobs and Now Can't Get Jobless Benefits. You're Left Watching Your Bank Account Slowly Bleed."
Oh, this is about the federal workers who are struggling to get unemployment benefits.
It is, and it seems like it's a growing problem.
Yeah, the MarketWatch article mentions a big increase in initial jobless claims filed by federal workers.
And they link it to those recent DOGE-fueled job cuts.
Right. But the bigger issue seems to be all the bureaucratic hurdles these workers are facing.
When they try to navigate the unemployment compensation for federal employees program.
It's leading to these long delays in people receiving the benefits they're entitled to.
And MarketWatch explains why this is happening. It's because the federal government doesn't give state employment offices regular updates on employee separations.
Unlike private sector employers, so it takes much longer to verify eligibility for benefits.
Which can be devastating for families who are suddenly without income.
Absolutely. One former federal worker quoted in the article says, "You're left watching your bank account slowly bleed."
And these delays can have ripple effects on the broader economy, too.
Because when people aren't getting their benefits, they can't spend money.
And that can hurt businesses and slow down growth.
It's a real problem now. Before we wrap things up, let's touch on a few other notable headlines that caught our attention.
Okay, what else is going on?
Well, gold has been on a tear lately.
Yeah, I saw that MarketWatch article. Gold is already topped $3,000. Here's what it needs to go up another 16%.
It crossed the $3,000 per ounce mark, which is a big psychological level.
It is, but it's still below its all-time high when you adjust for inflation.
Right. That was back in 1980, but MarketWatch thinks gold could go even higher.
They cite a few factors like persistent inflation worries and continued buying from central banks.
Yeah, gold is often seen as a safe haven asset, when there's a lot of uncertainty in the world.
And speaking of safe havens, Warren Buffett is apparently eager to give away some of his money.
Really? How so?
Well, Wall Street Journal has an article why this could be the year Warren Buffett gives away $1 million, and it talks about his annual March Madness contest.
Oh, yeah, the one for Berkshire Hathaway employees, where they can win $1 million for a perfect bracket.
That's the one. And it seems like he's tweaked the rules this year to make it easier to win.
Like he's really hoping someone gets it right.
He is, and it kind of makes you wonder if he's thinking about his legacy,
Leaving a mark on the world.
Yeah, exactly. Now, on a more serious note, CNBC has an article titled, "See You in 4 Years, Canada Flexes Economic Muscle as Tariff Negotiations Continue."
Oh, this is about the growing tensions between the U.S. and Canada.
Is President Trump's proposed tariffs and some of his recent comments have really rubbed Canadians the wrong way.
And they're starting to push back.
Yeah, CNBC says that Canadian consumers are buying fewer American products.
And there's talk of potential trade retaliation from the Canadian government.
So things are getting a bit frosty between the two countries.
It's a reminder that these trade wars have real-world consequences. They can damage relationships and disrupt businesses.
Absolutely. So as we wrap up this deep dive into the financial headlines, What would you say are the key takeaways for our listeners?
Well, I think the biggest one is that we're in a period of heightened uncertainty right now.
Driven by those ongoing trade tensions and a lack of clear policy direction from the government.
Exactly. And the Federal Reserve is trying to navigate this tricky environment. They're walking a tightrope between controlling inflation and supporting economic growth.
And China is making a big push to boost its domestic economy, realizing that they can't rely solely on exports anymore.
Meanwhile, the tech sector is grappling with its own challenges and opportunities, while the crypto market is reacting to these broader macroeconomic forces.
And we're seeing some important developments in the labor market, particularly for those federal workers who are struggling to get their unemployment benefits.
Plus, there are changes happening in the banking industry as they try to address those concerns about overwork.
So it's a complex and interconnected picture.
It is, and staying informed and understanding these connections is more important than ever.
Couldn't agree more. Well, thanks for joining us for this deep dive into the financial news.
It was my pleasure. Always happy to break it all down with you.
And that's it for us today. We'll see you all tomorrow morning with new headlines from major financial magazines.
Until then, happy investing, everyone.